in a world just drowning in information, how do we actually cut through all the noise, the jargon, and really get our heads around some of these, well, revolutionary economic ideas? Today, we're taking a deep dive into something called the guided market. It's a really fresh, maybe even groundbreaking perspective on how economic marketplaces could work.
Yeah, it's fascinating stuff. And our source here is a paper by Gaynor-Fray, same title, The Guided Market, a New Perspective on the Economic Marketplace. So our mission today is basically to pull out the core ideas, maybe some surprising facts, and definitely the practical side, the implications of this model. We want to help you understand how it really challenges traditional finance and, maybe more importantly, why it might be genuinely relevant for our economic future.
And the central idea, the thesis of this paper, it kind of hits you straight off. The guided market is suggesting this fundamental shift, right, in how we see capital, how we facilitate growth. It's saying, forget chasing ownership, let's put access first. And instead of the burden of responsibility, let's focus on pure convenience.
Okay.
So let's unpack that. When we think about traditional capital markets, I mean, the foundation is usually direct ownership. You own the stock, you own the bond, whatever the asset is, that's just how it works normally.
But what's really interesting here is how the guided market just flips that. It says access is actually way more important, more salient than owning stuff outright. And if you think about it, prioritizing access, it kind of opens up more doors, right? For growth, for inclusion, maybe, because you're shedding all the burdens that come with direct ownership, like maintenance, liability, actually holding the thing. It's more about leveraging the value without the weight of having to possess it.
Okay, so if ownership isn't the main goal, how does it function? What's the mechanism? The paper talks about a financial product being directly pegged to some underlying indicator or an equation, and its price is just directly correlated to that data feed.
Exactly. And that's right there where the name, the guided market, comes from. See, the model is designed specifically to negate all that unnatural fluctuation you get from market hysteria and sentiment, things moving just because people are panicking or getting excited. Instead, asset prices are literally guided by real-world data, by real-world change. It ensures this direct link to tangible information, not just speculation. It's about stability that's rooted in something verifiable.
Okay, let's talk transactions then, because the paper seems to have some pretty, well, revolutionary ideas about value exchange and liquidity, too. It mentions this idea of a shadow equilibrium between buyer value and seller value.
And what's truly different here, really revolutionary, is that this isn't your typical equilibrium. It's not about matching the supply of instruments to the amount of cash available. That's what we're used to. No, this is a dollar value equilibrium. The swaps are, as the paper says, value-based, not quantity-based, which basically means the actual number of shares or instruments involved. It doesn't really matter that much. What matters is that there's an equilibrium, a balance of the underlying value being requested on both sides. It's kind of like an intelligent clearinghouse matching total value, not just specific items.
Wow, okay. And it gets even stranger maybe when it reevaluates terms like buy and sell. The paper argues they're actually synonyms, not antonyms. That sounds completely backwards.
It does sound backwards at first, but it's a really profound shift in thinking. Look, the paper gives this simple example. Say, I want to buy 10 Apple shares with $1,000. Yeah, okay, fine. But you could just as easily frame that as, I want to sell $1,000 for 10 Apple shares.
Yeah.
See, it's not just playing with words. In a normal market, buy and sell imply there's someone else on the other side,
Right.
a counterparty holding the opposite thing. But here the system itself can generate the instrument or generate the cash equivalent based on that data value. So whether you're technically buying an instrument or selling cash, you're really just making a request for a value exchange.
Yeah.
And the system just fulfills it. It doesn't need a specific counter asset sitting there waiting. That's why the paper suggests using terms like requests for liquidity and requests for instruments. It's just more accurate for how the system works.
Right, which leads to this pretty crucial implication you mentioned. In this kind of ecosystem, the actual underlying instruments, they don't matter nearly as much as their cash value.
Exactly. And the reason why is critical. It's because instruments can be, quote, minted at will. Their price isn't set by supply and demand or scarcity like a traditional stock. It's determined purely by that underlying data indicator. So the paper argues this model is just much better suited for financing growth in today's digital economy where data is value. It's about being able to create the representation of value whenever it's needed, as long as that value is tied back to reliable data.
Okay, but One of the biggest worries, the biggest fears in traditional exchanges is always illiquidity, not being able to actually meet people's requests to buy or sell. So how does the guided market promise, because it's a huge promise that every single order gets a guaranteed fill and guaranteed price. How do they back that up?
It is a bold claim, definitely. And the paper outlines several pretty robust mechanisms to make it happen. Let's say requests for cash are higher than requests for instruments. More people want dollars than want assets. First, there's what they call an excess reserve fund. This is built up from profits and revenues, which, that part's pretty standard industry practice. Second, they can tap into a line of credit with a well-capitalized bank. Again, fairly standard. But then it gets really innovative with this offer alternatives idea.
Alternatives. Okay, tell me more about that. How does offering alternatives guarantee liquidity?
Well, imagine someone wants hard currency, maybe just for stability. The system can offer them a stable instrument instead. Think of this like an instrument pegged to something that doesn't really change much, maybe just fluctuates like 1–3%. Could be a basket of major currencies, perhaps. There's like an internal token or maybe a digital coupon that holds its value within the platform. It gives you a stable medium of exchange inside the ecosystem itself, so you don't always have to pull out external cash. It facilitates that internal liquidity and stops a run on the actual cash reserves.
Okay, that makes sense for stability. But what if someone isn't just looking for stable? What if they still want growth potential, just maybe not in cash right now?
Right, good question. And that's where the lucrative instrument comes in. Let's use the paper's example. Say you're selling an instrument that's pegged to the monthly percentage change in trees planted down in Florida. You want cash, but maybe you'd take something else if it looked more profitable. The system could then offer you instruments pegged to a different, maybe more favorable data indicator, like, say, the percentage change in trees planted in Georgia, if Georgia's planting rate is looking better. And crucially, it's offered in equivalent value and, theoretically, in limitless quantity. The point is, you can always be offered something of value, even if the specific cash you wanted isn't immediately on tap. It ensures your request for value is always met one way or another.
Okay, so that covers when cash demand is high. What about the other way around? What if there's a sudden surge in demand for the instruments? Requests for instruments are way higher than requests for cash.
Yeah, good point. So in that case where the dollar value of instruments being requested shoots up, the system can simply, well, issue necessary quantity. If there's suddenly, say, $5 million more in requests for those Florida tree planting instruments, the system can just mint the needed quantity and issue them. It doesn't mess with the price of each instrument. Because remember, the value is driven by the data, not by how many instruments exist. So creating more doesn't automatically devalue the ones already out there.
Yeah.
And just like before, they can also offer alternatives, maybe another lucrative instrument, if for some reason the primary one is constrained, though theoretically it shouldn't be.
So it really does circle back to that core promise. Every order has guaranteed fill and guaranteed price. And it stresses that instruments are sold at their exact valued moment. No spread, no requests filled slightly above or below the market price. They call it parity value, getting the true real-time value. That alone would streamline things hugely compared to traditional trading, right? Eliminates that friction.
Exactly. That's a key part of the efficiency claim. And what if the underlying data itself goes wild? Big fluctuations. The paper says the equation defining that indicator can be modified. They can use mathematical tools, exponential formulas, maybe put upper and lower bounds on it, use derivative formulas to make sure the instruments stay directly reflective of what that indicator is doing, not just vaguely correlated. This keeps the pricing robust, adaptive to how real-world data actually behaves.
Okay, we've got the philosophy, the core ideas down. Now let's make this concrete. How does it actually operate? The paper has some really helpful examples, diagrams even, that show these mechanisms in action. This is where it gets really interesting, I think. Let's peel back the layers.
Definitely. Let's walk through a couple of key scenarios from the paper's diagrams to see this minting and burning thing really work. So figure 1, the basic instrument pricing mechanism. That just shows visually what we said. The instrument's price tracks its underlying indicator directly. Indicator goes up, value goes up. Simple enough. Now let's look at a standard exchange. Example 2.2. You've got one person wanting to sell an instrument, let's say, tied to indicator ABC for $10 cash. Another person wants to buy a different instrument tied to indicator ABC also for $10 cash. What does the company, the platform, do? It effectively burns or retires the ABC instrument from the seller. It mints a brand new ABC instrument for the buyer, and it just transfers the $10 cash between them. See how it's not about finding a specific ABC instrument someone else is selling. The system creates it based on the value request. It's a smooth value exchange, not a clunky asset swap.
That dynamic, Burning and minting based purely on value, not quantity. It's fascinating, but what happens if the values don't match up perfectly? Like if the quantities people want to trade aren't a neat one-for-one swap in dollar terms, how does the guided market handle that?
Good question. That's example 2.3, and it shows the system's flexibility. Say person A wants to sell one like Z's instrument for $10, but person B wants to buy two AVC's instruments, and their total value is $20. So the company burns the one like Z's from person A. It mints two ABC for person B. It transfers $10 cash from B to A. But notice, person B paid $20. The company only needed $10 to pay A. So the company actually profits $10 in this case, essentially by minting that extra value represented by the second ABC's instrument. It really highlights this dynamic supply creation. The number of instruments floating around adjusts based on value demand, and is driven by the indicator's data, not by scarcity.
Okay, so looking at these examples, whether it's a simple swap like 2.2 or something more complex like 2.3, or even the really complex multi-party ones in Figure 3, the underlying principle seems to be that requests are always filled at the exact value stated.
That's the core promise, yes. Figure 3 shows even more complex stuff, like multiple people selling different things, one person buying something totally different, aggregating the value, or scenarios where the sell-side value is higher than the buy-side.
Oh yeah, 3.2, the value disequilibrium. What happens then?
That's where those reserves kick in. If sellers want $30 total, but buyers only want $10 worth, the company uses its reserves or credit lines to make up that $20 difference, ensuring the sellers get their full $30. Liquidity is maintained.
And 3.4 introduces that stable instrument again, right?
Exactly.
Okay.
Someone wants to sell $30 worth of XEEs, but instead of demanding cash, they accept the stable instrument X. This lets the company meet the seller's value request by minting X, which it can do limitlessly since its value is stable and internal without draining its actual cash reserves. It builds reserves while satisfying the user.
And 3.5 is just a straight swap, instrument for instrument, showing again it's about equivalent value, not the specific asset.
Right. So across all these cases, requests are always filled at that precise parity value. This whole model feels so detached from traditional finance sometimes. Where does something like intrinsic value, where does that even come from in this system if instruments can just be minted?
That's a really key question. And what the author argues, quite compellingly I think, is that the intrinsic value here comes directly from the quality and the reliability of the underlying data, the indicator itself. The paper uses a great analogy. Think about an instrument pegged to the price of gold. Does its value come from a vault full of actual gold bars backing it? Or does it come from the reliable real-time data feed that tells everyone accurately what gold is worth moment to moment? In this guided market system, it's the dependable data that becomes the source of intrinsic value. It's a pretty powerful shift in perspective. Value is found in the quality of information, not necessarily in physical scarcity or backing. And because these instruments aren't tied down by needing, material ownership or physical backing, you can theoretically issue an indefinite quantity without messing up the value of each individual instrument. This really drives home that idea of access being superior to ownership, doesn't it?
It really does. The paper uses that analogy of service companies like Uber or maybe Airbnb. Uber gives you access and convenience to transportation, right? But you don't have the burden of actually owning the car, filling the gas, doing maintenance, insurance, all that stuff. In the guided market, the instrument is sort of similar. It's backed by the equation, by the data value, which gives it immense flexibility. It frees you from the burdens that come with owning the underlying physical asset, if there even is one. It's about getting the benefit, the value exposure, without all the baggage. It fundamentally changes how you might think about what a financial asset even is.
So if we pull it all together, this format proposes a really fundamental shift in how we perceive capital, how we finance growth. Access trumps ownership. Convenience trumps responsibility. It's a completely different mental model for finance, isn't it?
It really is. Now, to be fair, the paper acknowledges that some similar financial products do exist today. Things like structured notes, maybe some income-based instruments have elements of this. But what the paper really emphasizes is that it's the overall ecosystem of the guided market. The way all these components, the data-pegged pricing, the minting, burning, the guaranteed fills, the alternative instruments, the way they all work together in central equipoise, as the paper puts it. That's what makes it potentially unique and particularly suited, perhaps, for meeting today's economic needs, especially in a digital world. It's the whole system, not just the parts.
And for this whole thing, this visionary system to actually function, the paper boils it down to three absolute necessities. You need a stable issuer running the platform, you need a well-capitalized financier to provide the backing and liquidity assurance, And underpinning everything, you absolutely need that constant flow of real-time, reliable data. Without good data, the whole thing falls apart.
Yeah, absolutely. And just to quickly recap the core takeaways, straight from the source material again. First, supply does not determine value here. Second, value is determined by real-world data. Third, remember, a request to sell is also a request to buy. Those terms get redefined. Fourth, traditional market forces like sentiment. They don't matter in the pricing mechanism itself. Fifth, orders get filled at parity value, the exact value, no spread. And finally, sixth, requests are always filled. That's the promise.
So, after diving into all this, what does it really mean for you listening? In a world that's clearly becoming more and more driven by data, where digital assets are definitely becoming more common, does a system like the guided market, one that truly values access over ownership and data over physical quantity, does it represent maybe the inevitable next step, the next evolution in how we think about and how we engage with capital? And maybe more personally, how might a shift like that, if it were to happen, transform your own understanding of what wealth even is and how you participate in the economy? Something to think about.